Most business owners are throwing away thousands of dollars every year because they chose the wrong business structure. In fact, 75% of business owners I meet are either in the wrong entity or they're not optimizing the one they have. Today, I'm going to show you exactly when an S Corp makes sense and when it doesn't. Look, I get this question almost daily. Should I switch to an S Corp? And here's what frustrates me. Most CPAs give you the same generic answer without actually looking at your numbers. They either tell everyone to become an S Corp because it saves on taxes, or they scare you away from it completely because of the extra paperwork. Both approaches are wrong. I'm Tiffany Phillips, CPA and tax strategist, and I've helped business owners save millions in taxes by making the right entity decisions at the right time. I just saved a client over $48,000 with one simple entity change. But here's what might shock you. I've also saved clients thousands by keeping them as an LLC when everyone else told them to switch. By the end of this video, you'll have the exact numbers, break-even points, and a clear framework to make this decision for your business. Plus, I'll share 3 advanced S Corp strategies that could save you an additional $28,000 per year. Let's start with why this decision matters so much. If you're operating as an LLC or sole proprietorship, you're paying what's called self-employment tax, and this is where most business owners are getting absolutely killed. Self-employment tax is 15.3% on all of your business income, not just some of it, all of it. So if your business nets $100,000, you're paying over $15,000 in just self-employment tax before you even touch federal and state income taxes. Here's what's happening. When you were an employee, you paid 7.65% in FICA taxes. That's your Social Security and Medicare. But your employer also paid 7.65% on your behalf. As a business owner, you're both the employee and the employer, so you pay the full 15.3%. Think about that for a second. If you're making $100,000 in your business, you're essentially giving the government a $15,000 interest-free loan every single year. That's money that could be going towards growing your business, investing in equipment, or building your wealth. Now, here's where the S Corp comes in. When you elect S Corp status, you split your income in 2 parts, salary and distributions. Only pay that 15.3% employment tax on your salary portion, not on the distributions. Let me show you the real math with an example. With business income of $100,000, your self-employment tax is $15,300. Federal taxes are approximately $10,000, state taxes approximately $2,000, which varies by state. So your total tax is $27,300. With an S Corp structure, the same business income of $100,000, but you take a salary of $50,000, a distribution of $50,000, so you split them in half. Your employment tax on the salary is only $7,650. Federal taxes, $10,000, state taxes, $2,000. Those two are the same. But your total taxes are now only $19,650, a savings of $7,650 per year. But, and this is crucial, you have to pay yourself a reasonable salary. The IRS isn't stupid. They know what you're trying to do, so they require that your salary reflects what you pay someone else to do your job. This is where a lot of people mess up. They either pay themselves too little and risk an audit, or they pay themselves too much and kill their tax savings. Here's where most advice completely falls apart. Everyone throws around different numbers for when you should switch to an S Corp. I've heard everything from as soon as you make any profit to wait until you're making $200,000. Both are wrong. The real break-even point isn't just about your income. It's about whether the tax savings outweigh the additional costs, because yes, there are significant additional costs that most people don't factor in. Some of those additional S Corp costs are payroll processing of $500 to $1,000 per year, a more complex tax return which costs between $1,000 and $2,000 and more per year, state franchise fees between $200 and $800 per year, compliance requirements, which are both time and potential penalties. The total additional costs vary anywhere from $1,700 to $3,800 or more per year. In our practice, we found the sweet spot is around $60,000 in consistent net business income. Below that, the costs often outweigh the benefits. Above that, the tax savings typically make it worthwhile. Let me show you the math at different income levels. At $40,000 in net income, potential S Corp savings of about $3,000, additional costs of about $2,500, the net benefit is $500. Probably not worth it. At $60,000 of net income, the potential S Corp savings are about $4,500, additional costs are about $2,500, so the net benefit is $2,000, and it's starting to make sense at this point. At $100,000 net income, the potential S Corp savings are about $7,650. Additional costs of $2,500, so the net benefit is about $5,150. It's definitely worth it here. But here's what's really important. Consistency matters more than one good year. I had a client who made $80,000 and immediately wanted to switch. But when we looked at her business model and projections, it was clear that was an anomaly. She was better off staying as an LLC and focusing on building consistent revenue first. The S Corp election works best when you have predictable, growing income and the systems in place to handle the additional requirements. Now let's talk about what really happens when you become an S Corp, because this is where a lot of people get blindsided. You have new requirements as an S Corp. A monthly payroll processing, even just for yourself, quarterly payroll tax filing, annual corporate meetings with documented minutes, corporate record keeping, separate business banking requirements, K-1 tax forms for all shareholders, and reasonable compensation documentation. If you miss any of these, you could lose your S Corp status entirely. I've seen it happen, and it's not pretty. Here's the thing. These aren't necessarily bad things if you're at the right stage of business. The additional structure can actually help you run a more professional operation and prepare you for growth. The problem comes when people make this election too early. I see business owners spending $3,000 a year in additional costs to save $1,500 in taxes. That's not strategy. That's just expensive. There's also the opportunity cost. All that time you're spending on payroll processing and compliance, that's time you're not spending growing your business. For some entrepreneurs, staying simple and focusing on revenue growth is the better choice. I had a client who switched to S Corp status when she was making $50,000. 6 months later, she was so bogged down in compliance that her revenue actually dropped because she wasn't focusing on sales and marketing. We ended up switching her back to an LLC. Now, if you decide an S Corp makes sense for your situation, there are some advanced strategies that can multiply your tax savings significantly. Strategy number 1, the accountable plan. This allows your S Corp to reimburse you for business expenses you pay personally, and those reimbursements are tax deductible for the corporation, but not taxable income to you. We're talking about home office expenses, business travel and meals, professional development, health insurance premiums, business equipment you purchase personally. Done correctly, this can save thousands more in tax savings beyond just the self-employment tax benefits. Strategy number 2, retirement plan supercharging. S Corps can set up powerful retirement plans like solo 401k that allow much higher contributions than you could make just as an LLC. A traditional IRA is $7,000 per year. Solo 401k through your S Corp is per year based on the 2025 limits. If you're in the 30% tax bracket, maxing out a solo 401k could save you over $20,000 in taxes annually. Strategy number 3, the Augusta Rule. This is advanced but powerful. Your S Corp can rent your home for business needs up to 14 days per year. That rental income is completely tax-free for you while being deductible for the corporation. I have a client who saves $12,000 per year just by having her S Corp rent her home for monthly board meetings at $1,000 per day. Completely legal, completely powerful. But here's the critical point. These strategies require proper documentation, legitimate business purposes, and usually professional guidance. They're not DIY projects, and if you mess them up, the penalties can be severe. So how can you actually decide? Here's my step-by-step framework. Number 1, check your numbers. Are you consistently netting over $60,000 per year? If not, focus on growing revenue first. One good year doesn't justify the switch. Step number 2, assess your business model. Do you have predictable income, or are you still in feast or famine mode? S Corps work best with steady cash flow because you need to run payroll every month. Step number 3, consider your growth plans. If you're planning to reinvest everything back into the business, the tax savings might not matter as much. If you're taking distributions to live on or build well, the savings become more valuable. Step number 4, evaluate your administrative capacity. Can you handle payroll, corporate formalities, and additional compliance, or will this become a burden that slows down your business growth? I had 2 clients with almost identical income levels, both making about $75,000. One switched to an S Corp and saved over $8,000 in taxes. The other stayed as an LLC because she was planning a major business expansion and wanted to keep things simple. Both made the right choice for their situation. Step number 5, consider your exit strategy. If you plan to sell your business eventually, S Corp status can provide some advantages in structuring that sale. If you're building a lifestyle business, it might not matter as much. Look, the LLC versus S Corp decision isn't about finding the perfect structure. It's about finding the right structure for where you're at right now and where you're headed. If you're consistently profitable, have predictable income, and can handle the additional requirements, an S Corp can save you thousands in taxes every year. But if you're still building, still growing, and still figuring things out, staying simple might be the smarter choice. The biggest mistake I see business owners make is either switching too early and getting bogged down in compliance, or waiting too long and overpaying in taxes for years. Here's my advice. Run the numbers. Look at your last 2 years of income, project your next year, and calculate the real cost versus the real savings. Don't guess. No. If you want the complete framework for making these decisions, plus 10 other strategies that can save you 30% or more on your taxes, grab my book, Your Biggest Expense, at yourbiggestexpense.com. The link is in the description below. Right now, you can get the book plus exclusive bonuses that include the exact worksheets I use with clients to calculate these break-even points for their specific situations. Don't let another year go by overpaying the IRS when you could be keeping that money to grow your business and build your wealth. The window for optimizing your taxes is closing fast. If this video helped clarify the LLC versus S Corp decision for you, hit that like button and subscribe to more tax strategies that actually work. And drop a comment below. Are you currently an LLC thinking about switching, or an S Corp wondering if you made the right choice? I read every comment and often turn them into future video topics. Make sure you're subscribed because I'm always sharing strategies like this that can save you thousands in taxes, and you don't want to miss out on what's coming next. Thanks for watching, and remember, keep more of what you earn.